Ever wondered what makes Warren Buffett one of the most successful investors in the world? When we talk about investing, it's impossible not to mention the name Warren Buffett. This man, often referred to as the Oracle of Omaha, is a beacon of financial acumen whose investment strategies have turned him into one of the wealthiest people on the planet. Warren Buffett, the chairman and CEO of Berkshire Hathaway, a company that owns businesses in insurance, rail transportation, energy generation and distribution, manufacturing, and retailing. The company is also a large stakeholder in many prominent companies in the US, such as American Express and Coca-Cola. He's a living testament to the power of smart investing. His phenomenal success is not a result of luck or chance, but rather the fruit of years of study, experience, and application of a set of investment principles that he has adhered to consistently. Buffett's strategies are not complex financial algorithms but simple, fundamental principles. They are built on the basis of understanding the value of money, the importance of knowledge, and the virtue of patience. They are strategies that are accessible to anyone willing to learn and apply them. Why should we understand and apply Buffett's investment advice and rules for success? Because they have proven to be effective. They have not only worked for Buffett, but they have also worked for many others who have followed his advice. They are not just strategies for investing, but wisdom for life, teaching us how to make sound decisions, manage risks, and build wealth over time. One of the most appealing aspects of Buffett's investment philosophy is its focus on long-term success. Buffett doesn't chase quick profits or get swayed by market trends. Instead, he invests in businesses he understands and believes in, and he sticks with them for the long haul. This approach may not make you rich overnight, but it can help you accumulate wealth steadily and surely, just like Buffett himself. So, are you ready to dive into the world of Warren Buffett's investment strategies? Are you eager to learn the principles that have guided him to his astronomical success? If so, you're in the right place. In this video, we will uncover 10 of Warren Buffett's investment advice and rules for success. Make sure you watch till the end. Welcome to Cash Flow Zone, the channel that caters to all your business and financial needs. This channel is a perfect fit for you. Here, we make business and finance easy to understand. We're all about empowering individuals and businesses with financial literacy. So be sure to hit the red subscribe button, like, and share the video. Firstly, Warren Buffett believes in the principle of investing in oneself. This isn't just about pumping money into stocks or real estate, but about pouring resources into your own skills, knowledge, and growth. Buffett, the Oracle of Omaha, often emphasizes the importance of enhancing one's abilities. He underscores the value of education, not just in the traditional sense, but also as a lifelong pursuit. He once said, "The more you learn, the more you earn." And he wasn't just talking about degrees and diplomas. He meant learning about the world, about people, about business, and about yourself. You see, investing in yourself is a strategy with guaranteed returns. It's about improving your tool set, the skills and knowledge you bring to the table. For instance, consider the art of public speaking. It's an asset in almost any field. Developing this skill can open doors to opportunities you might never have considered. In the world of investing, this self-investment takes the form of financial education. Understanding market trends, mastering the basics of trading, knowing the difference between bonds and equities. These are all essential skills for an investor, and they're skills that can be honed, just like any other. But it's not just about book knowledge. Buffett encourages individuals to invest in experiences too. Travel, meet new people, seek out mentors. The broader your horizons, the better your investment decisions will likely be. In essence, Buffett's principle of self-investment is about maximizing your potential. It's about becoming the best version of yourself, both personally and professionally. And remember, this isn't a one-time deal, it's an ongoing commitment. You don't just wake up one day fully formed with all the knowledge you'll ever need. It's a process. It's a journey. And it's one that can lead to significant success in investing and in life. So, take a leaf out of Buffett's book. Invest in your skills. Invest in your knowledge. Invest in your experiences. Remember, the best investment you can make is in yourself. Buffett's second rule is to understand what you invest in. This rule is straightforward, yet it's one of the most overlooked principles in investing. Buffett firmly believes that before putting any money into a business, one must first comprehend the ins and outs of that particular business. Let's delve into this concept a bit further. Understanding a business means knowing what it does, how it makes money, what its competitive landscape looks like, and what potential challenges it may face in the future. It's about being able to explain the business as if you were the CEO. With a thorough understanding, you are better positioned to assess the value of the business and predict its future cash flows, which are key to making sound investment decisions. This approach enables you to identify the businesses that are undervalued by the market, offering potential for higher returns. Take the example of Buffett's investments in the insurance industry. He didn't simply see it as a sector with potential, he understood the unique business model of insurance companies. He knew they collect premiums upfront and pay claims later, which allows them to invest the money in the meantime. This understanding led him to invest in Geico, which turned out to be one of his most successful investments. Or consider his investment in Coca-Cola. Buffett understood the power of the brand and the company's unparalleled distribution network. He saw the company's ability to generate consistent profits over the long term, which led him to make a substantial investment in Coca-Cola. But it's not just about understanding the business. It's also about understanding the industry the business operates in, the macroeconomic factors that could impact the business, and even the geopolitical influences that could affect it. By understanding what you invest in, you reduce the risk of making poor investment decisions based on hype or fear, and instead, make informed decisions based on solid understanding and analysis. So here's your takeaway. Don't let the allure of quick returns cloud your judgment. Remember, knowledge is power in the world of investing. So, always invest in what you know and understand. Buffett's third rule is to buy businesses, not stocks. This might sound strange initially, but let's delve into it. When Warren Buffett considers an investment, he doesn't see stocks as mere pieces of paper. Instead, he sees them as ownership in a business. Now, this shift in perspective is crucial. Rather than chasing fleeting market trends, he focuses on the long-term potential of a business. Why? Because owning a part of a business means you are partaking in its future profits. Imagine, if you will, a local bakery. If you were to buy a part of that bakery, you wouldn't just be interested in the price of the bakery's shares, right? You'd want to know about their product quality, their customer base, their competition, and their plans for expansion. Similarly, when Buffett buys stocks, he's investing in the future of that company. He looks at its business model, its competitive advantage, its financial health, and its management. He's not just buying a piece of paper, he's buying the opportunity to share in the profits of a successful business. This mindset helps to make more informed and rational investment decisions. Instead of being swayed by market volatility, Buffett looks at the bigger picture. He asks questions like, does this business have a sustainable competitive advantage? Is it managed by competent and honest people? Is it priced reasonably in relation to its intrinsic value? This approach requires patience and discipline. It requires thorough research and a deep understanding of the business. It's not about making quick profits. It's about investing in businesses that will grow and thrive over the long term. So the next time you think about buying stocks, remember Buffett's advice. Don't just look at the price tag, look at the business behind the stock. Consider its long-term potential. Consider whether it's a business you'd be proud to own. And remember, in the world of investing, patience often pays off. So, think of stocks as owning a piece of a business, not just as trading instruments. The fourth rule from Buffett is, don't try to time the market. Now, what does that mean? In essence, it's the advice to refrain from trying to predict the best moment to buy or sell stocks based on short-term market fluctuations. You see, the market is a complex beast, influenced by a multitude of factors, many of which are unpredictable. Even the most seasoned investors can't accurately forecast the ups and downs of the market consistently. Warren Buffett himself has been quoted saying, "We have no idea and never have had whether the market is going to go up, down, or sideways in the near or intermediate term future." This quote illustrates his belief that trying to time the market is not only futile but also potentially harmful to your long-term investment success. Instead, Buffett suggests a different approach. He advocates for long-term investing. It's about buying stocks in solid, high-quality companies and then holding on to them for an extended period. The rationale here is that, over time, these companies will grow and increase in value, which in turn will yield significant returns on your investment. Long-term investing also allows you to take advantage of the power of compounding. This is where the returns on your investment are reinvested and generate their own returns. Over time, this snowball effect can lead to substantial growth in your investment. Another advantage of long-term investing is that it can help mitigate the risks associated with market volatility. By staying invested over a longer period, you give your investments the chance to recover from any short-term market downturns. In conclusion, trying to time the market is a risky game that even the experts can't win consistently. Instead, focus on investing in quality businesses and holding on to them for the long haul. This approach allows you to grow your investments steadily over time, rather than trying to make a quick buck on short-term market fluctuations. Remember, it's time in the market, not timing the market, that matters. Buffett's fifth rule is to be fearful when others are greedy. This sage advice taps into the heart of human psychology and market dynamics. It's all about understanding the emotional undercurrents that drive market trends and the consequential irrational decisions. Consider this. When the market is booming and everyone is buying, it's easy to get swept up in the excitement. People see their friends making money, they hear stories of incredible gains, and they don't want to miss out. This is the point where greed kicks in, and caution often gets thrown to the wind. But Buffett, the Oracle of Omaha, advises us to be wary in such times. Why? Because when everyone is overly optimistic about investments, it often means that assets are overpriced. The market is inflated, and the bubble is about to burst. Buying into the hype can lead to significant losses when the inevitable correction occurs. On the flip side, when the market is down and investors are running scared, that's when the real opportunities arise. People are selling off their investments, prices are falling, and the general sentiment is pessimistic. But for those who can maintain a cool head and see beyond the fear, this is the time to buy. Why? Because this is when assets are often undervalued. The market is in a slump and prices are at a low. It's the perfect time to pick up valuable assets at a fraction of their true worth. And when the market eventually rebounds, which it always does, those assets will appreciate in value. So Buffett's fifth rule is about mastering your emotions and resisting the herd mentality. It's about finding the courage to go against the grain, to buy when others are selling and sell when others are buying. It's not about being contrary for the sake of it, but about being rational and thoughtful, about seeing the opportunities where others see only risk. So always maintain a level-headed approach towards investing. Be fearful when others are greedy, and be greedy when others are fearful. It's a simple rule, yet it's one of the most powerful tools in the investor's toolbox. The sixth rule from Buffett is, be patient. Just as a seed planted in the ground doesn't sprout overnight, a successful investment strategy doesn't bear fruit in a day. It requires patience, perseverance, and a steadfast belief in the process. Buffett himself is a stalwart advocate for patience in investing. He once famously quipped, "The stock market is a device for transferring money from the impatient to the patient." There's profound wisdom in this remark. In the world of investing, those who are able to stay the course, resist the urge to make rash decisions, and wait for their investments to mature, are often the ones who reap the most substantial rewards. So how does patience play out in practical terms? Well, consider the concept of long-term investment strategies. These strategies often involve buying and holding onto stocks for years, even decades. While this approach might not provide immediate returns, it allows for the power of compounding to work its magic. Over time, the small gains accumulate, snowballing into substantial wealth. Think about it this way. If you planted an apple tree today, would you expect to enjoy its fruits tomorrow? Of course not. You'd nurture it, water it, and patiently wait for it to grow. Similarly, investments need time to flourish. Buffett's patience is also evident in his approach to buying stocks. He doesn't rush into investments. Instead, he waits for the right opportunity, the right price, and the right circumstances. He's not swayed by market trends or hot tips. He sticks to his principles, waits it out, and makes his move when he's confident that it's the right decision. So the next time you find yourself itching to make a quick buck in the stock market, remember Buffett's rule. Be patient. Give your investments the time they need to grow. Don't let impatience dictate your decisions. In this fast-paced world where instant gratification is the norm, patience in investing can seem like an outdated concept. But Buffett's track record speaks for itself. Patience, it seems, is not just a virtue, but also a key ingredient in the recipe for investment success. Remember, Rome wasn't built in a day, and neither will your investment portfolio. Buffett's seventh rule is to diversify your investments. Now let's dive into what that really means. Diversification is a cornerstone of sound investing, a strategy that Buffett himself has championed for many years. It's all about not putting all your eggs in one basket. Instead, spread your investments across a variety of sectors and asset classes. This way, if one investment doesn't perform well, you're not left high and dry. You have other investments that may be performing better, balancing out your overall portfolio. Buffett's philosophy here is rooted in the simple reality of the market. It's unpredictable. Even the most seasoned investors can't predict with certainty which investments will soar and which will sink. By diversifying your portfolio, you're essentially hedging your bets, ensuring that you're not overly reliant on the success of any single investment. Now, you might be wondering, how does one go about diversifying their investments? Well, there are several ways to do this. You can diversify by asset class, meaning you invest in a mix of stocks, bonds, real estate, and perhaps even commodities. You can also diversify by sector, spreading your investments across industries like technology, healthcare, finance, and consumer goods. And you can diversify by geography, investing in domestic and international markets. However, it's important to note that while diversification can help mitigate risk, it's not a bulletproof strategy. Even a well-diversified portfolio can experience losses, especially during periods of market volatility. But the aim of diversification isn't to guarantee gains or completely eliminate risk. Rather, it's to create a balance that can weather the ups and downs of the market, providing a more stable long-term investment journey. In the end, Buffett's advice to diversify isn't about chasing the hottest stocks or trying to beat the market. It's about creating a well-rounded portfolio that can stand the test of time and provide a solid foundation for your financial future. So always remember to diversify your investments to spread the risk. The eighth rule from Buffett is, avoid borrowing to invest. This nugget of wisdom from the Oracle of Omaha, as Warren Buffett is often called, is particularly important to understand and implement. Borrowing money to invest can seem like a tempting strategy, especially when interest rates are low and potential returns appear promising. However, it's a path fraught with risk and potential disappointment. You see, when you borrow to invest, you're essentially betting that your investments will yield a higher return than the interest you owe on the debt. But the future of the market is uncertain, and if your investments don't perform as well as expected, you could end up in a precarious financial situation. Buffett's advice underscores the principle of investing within your means. He advises against falling into the trap of using debt to fund investments. There's a simple reason for this. Investments can go down as well as up. And if they go down, you still have to pay back your debt, with interest. Let's take a hypothetical scenario. Suppose you borrow $1,000 at an interest rate of 5% per year, hoping to invest in a stock that you expect to return 10%. If your prediction comes true, you've made a profit. But what if the stock only returns 3%, or worse, it falls in value? You'll still be on the hook for the original $1,000 plus the 5% interest. The risk of borrowing to invest is magnified if you're using leverage, which is essentially borrowed money. With leverage, potential gains are magnified, but so are potential losses. And those losses can exceed your original investment, leaving you in debt. Remember, investing isn't a get-rich-quick scheme. It's a long-term strategy that requires patience, discipline, and prudent decision-making. Borrowing to invest is like trying to run before you can walk. It might get you there faster, but the risk of stumbling and falling is much higher. So, always invest within your means. Buffett's ninth rule is to invest consistently. Now, what does that mean? Well, it's like going to the gym. You don't just go once and expect to see a significant change. You need to go regularly, consistently, to see the fruits of your labor. And that's exactly what investing is all about. Consistent investing is about making regular investments, regardless of the market conditions. It's not about trying to time the market or waiting for the perfect moment to invest. It's about making investing a part of your regular routine. You see, when you invest consistently, you're taking advantage of a concept known as dollar cost averaging. This is a strategy that involves investing a fixed amount of money at regular intervals, regardless of the price of the investment. Over time, this strategy can reduce the impact of volatility on the overall performance of your investments. Let me paint a picture for you. Imagine you have $100 to invest every month. In January, the price of the investment is high, so you buy fewer shares. In February, the price drops, so you buy more shares. Over time, the price averages out. You're not concerned with short-term price fluctuations. You're committed to a long-term investment strategy. Now you might be wondering, what if the market crashes? Well, that's where the magic of consistent investing comes in. If you're investing regularly, a market downturn simply means you're buying more shares at a lower price. When the market eventually recovers, as it always does, you'll be in a much stronger position. The power of consistent investing isn't just about the financial gains, it's also about the discipline it instills. It encourages you to save regularly, to live within your means, and to think long-term. It forces you to ignore the noise of the market and to focus on your own financial goals. Investing shouldn't be a one-off event spurred by a sudden windfall or a hot tip. It should be a habit, a part of your regular routine. So, make investing a habit, not a one-time event. The final rule from Buffett is, always have a margin of safety. This principle is as fundamental as it gets in the world of investing. But what does it mean exactly? Well, it's all about providing yourself with a safety net. In the context of investing, a margin of safety is the difference between the intrinsic value of a stock and its market price. In simpler terms, it's buying a dollar for 50 cents. This concept is not about buying cheap stocks, but rather about buying good stocks cheap. It's about recognizing the inherent unpredictability of the market and making sure you're protected against it. You see, the stock market is not always rational. Prices can fluctuate wildly due to a myriad of factors, many of which are completely unpredictable. The intrinsic value of a company, however, is more stable. It's based on the actual performance and assets of the company, not the whims of the market. When you buy a stock below its intrinsic value, you're essentially providing yourself with a cushion against these market fluctuations. If the price drops, you're protected because you didn't pay the full price to begin with. And if the price rises, well, that's just icing on the cake. But how do you determine the intrinsic value of a stock? That requires a bit of homework. Analyzing the company's financials, understanding its business model, and considering its growth prospects. It's not easy, but it's absolutely essential for implementing the margin of safety strategy. Remember, the goal is not to predict the market's movements. That's a fool's errand. The goal is to protect yourself against the market's unpredictability. It's about being prepared for the worst while hoping for the best. So, always have a safety net when you invest. It's not just about maximizing profits, but also about minimizing potential losses. Because in the end, the most successful investors are not those who take the biggest risks, but those who manage their risks the most effectively. That's the essence of Buffett's 10th rule: always have a margin of safety. These are just a few of the investment strategies and rules for success that Warren Buffett follows. And we've had the privilege of delving into them one by one, gleaning from the wisdom of one of the most successful investors of our time. We started with the core principle of investing in oneself. Buffett himself is a lifelong learner, always eager to acquire new knowledge and skills. This is a cornerstone of his success and a rule he highly encourages. Our journey then took us to understanding the importance of knowing what you invest in. Buffett's rule of thumb is simple: if you don't understand it, don't invest in it. This way, you're not gambling with your money but making informed decisions. We also discussed the concept of buying businesses, not just stocks. Looking beyond the stock price and understanding the business itself is what separates the wise investor from the crowd. We've talked about the perils of market timing, a game that even Buffett himself doesn't play. Instead, he focuses on the long-term potential of his investments. We've also delved into the contrarian wisdom of Buffett's philosophy, being fearful when others are greedy, and vice versa. This strategy helps to avoid the pitfalls of following the herd mentality. Patience, we've learned, is more than just a virtue in the world of investing, it's a necessity. Buffett's buy and hold strategy is a testament to the power of patience. We've explored the importance of diversification, the safeguard against any unforeseen downturns in any one investment. Avoiding borrowing to invest was another rule we navigated. Buffett's stance on debt is clear. It's not a tool for successful investing. We've also learned about the importance of consistent investing. Regular, disciplined investment can compound over time, leading to substantial growth. And finally, we talked about the concept of having a margin of safety, a buffer that protects you from the unpredictable nature of the market. Each of these rules is a piece of the puzzle that can lead us to financial success. Grasping and applying them is key to becoming a successful investor, just like Buffett. Remember, investing is a marathon, not a sprint. Apply these rules and you'll be well on your way to financial success. We have a video on new business ideas. Watch the video to learn more about a business to start so that you become the next Warren Buffett. The link of the video will be in the description, and let us know in the comments what other topic you will want next. Thanks for watching today's video till the end. Click on the link below to watch more videos from Cashflow Zone. This video is very educative and can help others. Please share, like and subscribe. Hit the bell notification so that you don't miss any one of our videos. See you in the next one.